So the DXY made a lower low from the 11th last month until the 1st. Now, in the same time period, EU was going higher, was going up. Okay, so this is a normal correlation we like to see between Euro and the DXY. Okay, so if DXY is going down, you want to see Euro go up the same time period. So USD XSFC divergence, I taught you guys last week. If one pair is doing something, you want to see the other pair do another thing. Okay, different thing. So if DXY is going down, you want to see EU go up, and then GBP USD go up also. Now, in the time period where the DXY was going down, Euro was making higher highs, and the pound made a lower high. So DXY making lower highs, lower lows. EU, as is meant to be, making higher highs, higher lows, while GU making lower highs, lower lows. That tells you something. Okay, tells you there's a crack in correlation between DXY, EU, pound. Okay, so you guys all know what's going to happen. Right, so now, what do you think is going to happen? Is DXY going to keep going down, or the DXY is going to go up? So what direction do you want to see the DXY do now that you've seen it make the USD XSFT divergence? So for those guys who attended the bootcamp, let's see your responses. Retracement, then down, okay? Let's see. Up. Yeah, so is the DXY going up or, yeah, it's being recorded. Is the DXY going up or down? So don't just say up, say DXY up or EU up or GU up, down. Okay, DXY up. Okay, 4 replies. Yeah, DXY up, correct. DXY up, EU down, GU down. Correct. So the first thing I did was to check for the USD XSFT divergence between DXY, EU, then GU. Then, I know I've actually not taught you guys about this, but using the, just go to www.barchart.com to get access to treasury notes. Yeah, 1018 nodes, 518 nodes, 218 nodes, and basically, if you want to get access to futures contracts, use barchart.com. Okay, so what I'm trying to look for here is open interest. So normally, before price makes a major move up, okay, you're gonna see open interest drop down about 15%. So now, for those of you guys who don't know what open interest is, I'm not actually going to cover that on this session. Okay, it's going to be for this week. Okay, I'm going to do that later this week. So, and for those guys who are more familiar with COT, open interest, and all that, whenever you get to a level of support, you want to see open interest do something like this. Okay, normally you're going to see the open interest go up, down, up, down. But when price starts to get towards a level of support, okay, you're going to see a very, very rapid or sharp decline in open interest. So open interest is going to go up, down. Then out of the blue, you're going to see, boom, drops off suddenly. Okay, so the open interest is going to drop off suddenly, then it's going to start going up. So what that happened is the institutions are offloading the last sell positions. Okay, so you're offloading sell positions to assume the buy side of the market. So what they did here is, let's see, let's use brush tool. So somewhere around here, they sold off. Somewhere around here, they sold off. And then finally, these completed the last sell. Okay. For them to realize profits of these sells, the market needs to trade below the last swing, which the market did here. Now, I'm not saying DXY is going to go all the way back up to this point. What I feel is there's going to be a massive range, okay? Massive range. So DXY is basically going to just range around. Now, the reason why I'm saying this is because if you look at the treasury notes, it's making lower highs, lower lows, okay? Now, facts about the treasury notes. If the DXY is going up, you want to see the treasury notes go down. Okay, so the T notes, the 10, especially 10-year treasury notes, does the opposite of what DXY is doing. So if DXY is trending upwards, you want to see the treasury notes trend downwards in the normal market environment. But now, in a situation where the DXY is going down, lower highs, lower lows, and the 10-year T notes are also trending down, that creates kind of a range bound market. So what's going to happen is the market is not really going to make like real vertical trends. Okay, it's going to go up, down, then from down, up, like that. Okay, so I could go back to 2015 and show you clear examples of when this happened. I'm just trying to explain to you guys. So for you guys who understand, or you might have attended webinars on open interest and 10-year treasury notes, this is what I feel is going to happen in the market. So I feel this week is very interesting because I'm looking at the DXY going up to take out the 20-day EBITDA data range and possibly taking out this range to come back to this 3-day order block. So there's an order block still here, unfulfilled range. Let's make this less thick. So there's an unfulfilled price range around this level. 3-day bearish order block. Okay, just equalize. Okay, so this is a 20-day EBITDA range and 40-day EBITDA data range. Now, I'm coupling this with the fact that using seasonal tendencies, but it's not really a strong one, DXY likes to rally around January. So around January is going to start rallying to create kind of like an eye around March. So it's going to rally from January going to February, create an eye around March, then drop down going into June, July, then make it low, probably a bullish market, then rally to the end of the year. But I feel this year DXY is going to be very bearish. So I'm looking at the DXY rallying till around March, which is where you see my vertical line, and then dropping out. Now, this is all speculation. We need to see the market do what we want to see it do. Okay, it's all speculation. So now the market could still come back down because this is a range low to a range high. Okay, so there's a range low, range high. Okay, we call bearishness until January. Now the market is here. So the market could possibly go up, take out the 20-day EBITDA range and the 40-day IPDA range, and the market could still go down. But now we have USDX SMT divergence, which is number one. Number two, we have 15% drop in open interest. Okay, there was a 15% drop in open interest, coupled with the fact that around this time of the year, we want to see DXY go bullish. So this is the reason why I'm looking at bullishness on DXY. Now, obviously, we're looking for bullishness on the DXY. Okay, we go down to the smaller time frames. Let's see. So we are looking at DXY getting towards this level by this week. So I want to see DXY go to this level this week. Now, at the same time, we're not being specific that this is what DXY is going to do, okay? We're still giving in all the possibilities that the market could still go down further. But we are banking on the buy side of the market, on DXY, Okay, until the market shows us otherwise, this is what we're going to stick to. Now, if we're going to be bullish on DXY, that means we are bearish on EU, GU, gold probably, NU, AU. Okay, so EU, I'm looking at bearishness. So what I did here was I marked out all the institutional references. Okay, so daily order blocks, 4-hour OBs, mitigation blocks, 20-day EBITDA range, the lows. So if you look at my look at my EU chart, for example, you're gonna see X's. Okay, this blue X's. So this is simply just marking up the range high and the range low. So 20-day EBITDA data range low, 1, 2, 40-day range low. I don't actually think the market is going to get to this level, but I do know short term the market could reach for this level. Okay, so most likely I would like to see the market go up first. Monday going to Tuesday, I want to see the market go try to get back to this level. Okay, so it's going to be a failure swing. The market tries to get back to this level one more time. I'm going to count that as a failure swing, then try to sell that. So it's depending upon the time of the day, the day of the week. So if the market is bullish Monday, Tuesday, that is going to verify the bearishness. Okay, but if the market is bearish Monday, Tuesday, Wednesday, I'm going to be kind of doubtful if you could see more bears in the market. So we all have to count the days of the week take the days of the week into consideration, because if the market is going to be bearish, then from Monday to Tuesday, you want to see the market open, then create the high of the week, then drop off. Okay, I taught you guys last week. Bearish environments, you want to see open. Let's make this open, high. Okay. So open, high, low, close. Okay. Bearish environment, want to see the market open first, drop down, then pull back, then close. So this gives us the bearish weekly candle. Okay, so the same way we want to see the market do for EU. If we're expecting a bearish week, we want to see the market open when it chooses bullish to our institutional levels, one of our institutional levels, then we're going to use the time of the day to get our entries, and then we're done for the week. Okay, so I have all the pairs marked out. Now let's see the questions. Yeah, wow. Okay, perfect. So GU obviously is bullish. Okay, GU was very bullish because so now the reason why I expected GBP USD's bearishness, sorry, not bullish, bearish. Now the reason why I expected pound USD to be bearish is because we went to a very massive level of liquidity in the market. Okay, very, very massive level. This level is a very massive level in price. So price went up, came down, made a reversal, yeah, then went up, traded into this level. So now there's gonna be lots of buy stops resting just above this level. Not retail buy stops, institutional buys. I'm talking about the funds now. So the hedge funds are gonna have lots of massive orders placed around this level. Now, what is going to happen is the market is going to tap that level, and you want to see the market make a lower low. Okay. So GU would have been an excellent trade to an excellent pair to have traded the past few weeks, or the last 2 weeks actually, because this was perfect institutional concept. Price traded into a very key massive level where the fund will have buy stop resting around that level. Quickly pull down. You want to see break in price action. Then price is going to give you a failure swing. So even before we had a USDX SMT divergence, I already predicted this. I think my trading journal. Yeah, because I wanted to see pound USD go down and EU go up and DXY go down. So DXY is going to go down, EU goes up, and pound goes down. That is divergence. Means funds are moving uh, from the foreign currencies into DXY because now we are in a risk-on scenario. So remember, just two market conditions. Okay, there's risk off, risk on. Risk off is bearish DXY. Risk on is a bullish DXY. Okay, so now we are expecting bullish DXY, which translates to a risk on market scenario. Okay, so if we're risk on, meaning we want to sell foreign currencies paired against the dollar. Okay, so now I'm looking at, I feel obviously the pound USD is going to come all the way down to this level. Most likely it's going to take out this level. Okay, so if I assume a position around any of these areas, I'm holding or I'm going to swing all the way down to this level because there's still lots of unfulfilled range below this level. Massive. Okay, so it's massive. And the reason why I would like to see the market get down to that level is because I feel there's going to be lots of sell orders resting around below this level. Okay, so there's going to be massive sell liquidity just below this level. So there's lots of reasons to expect why the market is going to get down to this level. Now, if you attended the bootcamp, I told you that when you see the markets like this, when you see liquidity voids or equal highs or equal lows, okay? The market is going to get attracted to those levels, especially if those levels are daily levels, okay? Daily levels meaning higher time frame levels. So your higher time frames are your 4-hour, daily, your weekly, your monthly, okay? So equal lows, fair value, liquidity void, market imbalances, they're all going to be magnet for price. So you're going to attract price back to them because the market needs to fulfill the range. Okay, so now I'm looking at this as a range low to a range high. So I feel the market pound years, I want to see it drop for like the next one month or so. Probably till the end of January. I want to see the market drop. Because getting a USDX SMT divergence, from my own experience, the market usually lasts from this kind of moves for like 3, 4, 5 months. Okay, so this could probably last until March. The market on DXY could just go take out the 20-day EBITDA range, 40-day EBITDA range, and then just range. Then towards March starts to drop. Okay. But short term, we're looking at the market going to this level first, then to the 40-day EBITDA range, then to this level. So let's see what the DXY does. But if you look at your smaller time frames, you're gonna see that from lower swing highs, lower swing lows, we had a break in market structure, and now the market is showing signs of bullishness. So the market is showing it wants to go up. So the only thing we're going to look for is just time entries, and then we're good to go for the week. So EU down, pound USD bearish. I draw this 4-hour order block. This would be the most ideal scenario for me. Want to see the market go up, take out the side. I feel there's still small retail liquidity resting just above the side. Market should take that out, then get to this level, and we're good for a perfect sell. TP1 is obviously going to be daily order block, then TP2, and then swing to lower levels. So now gold, let's see gold. Okay, so we called out bullishness on gold from around this level all the way. We're expected gold to rally all the way to this level for about 982 pips unfortunately, I think I was the only one who held through gold. So I called out a trade, and I was the only one who paid attention to what I was calling out. But anyways, like I said before, I said when gold took out this eyes, because it was sitting in a massive range. So there was a massive range in gold around this level. And I called when gold left this level, it was going to be just a very quick move out of the box, all the way to this level, then to this level. And we got exactly as we called quick moves. The market shut up and kept going up until it got to this level. Now, obviously, whenever you see the market do stuff like this, when the market just starts going in one direction vertically for for an extended period of time, it's obviously going to be market imbalances because the price was too quick to fill volume at a particular price point. So usually the way the market moves is order comes in, okay, the order influences the market, then institutions take upon that order, either you're doing the opposite of that order or they're somehow, some way, okay, you're gonna take those orders and then that causes the market to go up. So for example, if you want to see the market go up, okay, there's gonna be lots of positions assumed down here. Now as the market goes up, the fund orders are going to be paired with the institutional orders. Okay, so the fund sell stops or buy stops, sorry, are going to be paired with that of the institution, and then the market is going to rally. Now, if the institutions were bearish, okay, if the institutions were bearish, you're going to have protective orders around old eyes. Okay, there's going to be protective orders around old eyes. So now let's assume the institutions, because your long-term trend following, assumed sell positions around this range. So while we're assuming sell positions, the institutions did the opposite of what they were doing, assumed buy positions. So now we know from our analysis that we were on the side of the institutions because we were biased. Okay, we're bullish. Now, if you're selling, you're going to have protective sell stops. Sorry, buy stops because you're selling. There's going to be protective buy stops at this level, at this level. So as the market gets back to old eye, you're going to see a quick push in price, okay? So price is going to push up quickly. Now, the reason why is because the market just activated the buy stop orders of the institution. So now let me show you guys an example. Let's use the 4R. Come down to this level. Now you're gonna see around old eyes, there's always gonna be a quick burst in price. Okay. Now notice how when the market got to this level, it stalled a bit and then boom, one huge candle. Market got to this level, stalled a bit, then boom, one huge candle. The reason why you're seeing huge candlesticks like that is because the market is at that time paired with fund. So the market at that time is paired with fund orders. So that tells you, okay, that somewhere inside this range, the funds were selling because to them, gold will have been on a downtrend. Okay. Now, if you're selling, you're going to protect your orders with subs, buy subs, protective buy subs just above old eyes. So whenever price gets to those old eyes, you're going to see a quick move in price. Okay. Now, this is why whenever you're buying or selling, your TP is going to be old eyes, old lows. Okay. Old lows, old eyes. But it's going to be some form of the market having protective orders around those levels. Okay. Now, gold rallied up, got to this level. And at the period where gold was going up, DXY was also in the same time frame going down. Now, we're looking at bullishness on the DXY because if you go to your futures contracts, you're seeing, give all the reasons why USDX SMT divergence, and we have open interest dropping about 15-20%, which is usually what the market does typically before it rallies up. So These are all reasons why I want to see DXY go up. Now, if you want to see DXY go up, you want to see gold do the opposite and then go down. Okay, so if DXY is going up, commodities go down. Okay, so bullish DXY, bearish gold. Now that tells you that there's gonna be massive fund level liquidity just above this level. Okay, so perfect. Right, so there's going to be massive fund level liquidity just above this region. The market is going to get there. We want to see the market start to stall around this level, around 1552.480. Now, should we get a break in market structure, that is going to be the confirmatory price action we need to sell gold. So I'm going to focus on selling gold this week. What I feel gold is going to do is it's going to trade up, maybe dip into this level, okay, for a breaker. So what the market will do is, what I feel is going to do is, if the market pulls below from this level, then it's going to try to attack this level one more time, okay, then pull down. Now, once you get a, let's see, 15 minutes, okay, right. So once the market starts to take out this low and this, okay, then we could start looking at retracements to sell off gold. Okay, so we're going to look for retracement, sell off gold, for gold to come back down and fill up all the thin price action below, because there's lots of thin price action all around this level, thin price action. So I'm looking at gold being bearish for like the next 20 days, 40 days. Okay, so I'm looking at bearish gold for like the next 20 to 40 days of price action, because I want to see gold ideally fill up this level. Now, gold is still bullish. By all means, what the market is showing us is a clearly bullish environment, but I feel we're going to get a reversal from this level all the way back down to this level. Okay, so let's see, NZD USD, it's the same thing. So we go to the daily time frame, look at what the market is doing. Let's see, daily, yeah. So there's explosive price action on NZD USD. The market went up, okay, and the market came to this bearish order block. So we called bullishness on the market. We said the market was going to keep going up until the market got to this level where it's going to stop. Now, the reason why was because there was nothing, okay, there's nothing institutionally around all those levels why we want to see the market stop until price got to this level. Okay, so this is why we're looking at bullish NU until we came to this level. And now the DXY is actually verifying what we called out months beforehand, bearish NU. Now, what we're simply doing is we're waiting to snipe for the sell on NZD USD. Okay, so see the market came to that bearish order block. We got the confirmatory breakdown in market structure. If we were trading last week, would have been a clean sell, okay, on NZD USD. Now, if we are in a bearish environment, we want to see the we're looking simply for retracements up to sell, okay. And I'm looking at the market coming to this breaker to tap this level, because since the market broke down, never got back to this level. Okay, so I'm looking at the market going back up to this level, then selling. So if the market can get to that level, it's going to be a very, very clean sell for us. Very clean, because we're looking at about we're looking at TP1 is gonna be 118 pips. TP1 118 pips. TP2 gonna be just a little over 150 pips. Okay, so There's lots of opportunities on NU, GU, EU, gold, AUD is the same thing. If we're looking at bearish GXY, sorry, if we're looking at bullish GXY, then we're looking for bearishness on these Forex pairs. So 80 years, what I simply did was I went to the lows, marked out the 20-day IBDA low, 40-day IBDA low, and I'm looking at the market getting at least this level. So we could get a retracement back up Monday going to Tuesday, and then it's going to be a clean sell all the way down. Okay, to this level. So definitely you guys, sorry, I'm not actually sure I'm going to send out these charts to SMT Trader Digest. I'm just giving you guys what I feel is my bias for the week, because we still got a boot camp going on. So one of these every day, before each session, I'm going to do a quick market update from what we saw in the charts, how the market played out, explaining all of that, along with what I want to teach and all that. Okay, so this is like a weekly trade forecast. Thinking about doing this every Sunday, so that help me if I stick to it. So pound, yen, 4R daily. Okay. All right, so the pound yen, we had a bearish order block. Okay, bearish order block. Now, you might ask, why did we not factor this candle as order block? Well, because if you look at this candle absolutely engulfs this candle. Okay, this candle was engulfed by this candle, so this for me is the order block. Okay, not this small candle, this candle for me was the order block. So if I was gonna trade yen, pound yen, okay, when I'm gonna teach after this weekly recap, equal highs, equal lows, and institutional manipulation and stop runs. So this is a very clear example, because you have equal highs around this level, and then you have a daily order block just around this level. So what if you're unable to sell the market from this level? Okay, so where you should be getting your sells is from this level. If you're unable to sell from that level, once the market breaks past the last bearish candle, which is this bearish candle, you could have been short from here all the way down. Okay, this simply is a breaker. So you will have been short from either this level or once the market breaks past that level, because we are bearish on pound yen. The reason why we are being bearish on the pound yen is because we have higher high, higher lows, higher high, higher low, higher high, then a lower low. That tells you break your market structure, okay? So lower low, the market is going to come back up for a retracement back into daily order block. Then the market is going to drop down, okay? So we're going to be lucky if we get the market, if the market is going to pull all the way back up to this mitigation block, but I highly doubt that. But we're looking for every retracement to sell pound yen, because we're bearish on pound yen, okay, as there's a lot of massive liquidity below pound yen, very, very massive, okay? And if you look at the pound yen, the market was able to get to this level. Let's see, this level. Okay, perfect. So the market got all the way to this level, and you can best expect that there's going to be fund level stop orders resting, productive stop orders resting just above that level. Now, once the market grabs, the market has to quickly pull away from that region. Okay, so pound yen would have been a perfect sell setup. But now this week, we're going to focus on trying to sell the pound and then yen. Now, Euro GBP, I'm just looking at this being bullish. For the meantime, looking at this being bullish on Euro GBP because I feel there's a lot of this is equal eyes resting around this level. Okay, equal eyes resting around that level. Very thin price action around this level. So we can look at the market retracing down. Let's see. All right. So what I actually had marked out is on Euro pound is just equalize around this level. You go to your 1 hour time frame, just equalize Euro pound, equalize around that level. Definitely there's going to be retail stop orders resting just above. So I think for Monday, tomorrow, today, whatever time zone you're in, Monday we're going to get bearish Euro pound because there's equalize around here. There's a 1 hour order block there. So looking at the pound going up, tapping that order block, then trading all the way down to higher time frame support level. And then from there, from there, we're going to see the market then very well push up. Okay, so from Monday, I'm looking for the sell going into Tuesday, Wednesday. Then from Wednesday, I'll be if the market gets around this level, one of these levels, then I'm gonna look for buys and hold until next week. And I know it's not exactly the way you want the market to play out. That the market is gonna play out definitely. Okay, you can't tell the market what it's gonna do, so you can only anticipate what the market is gonna do. So if the market tomorrow rallies up going into London session to around this zone, I'm selling Euro pound and I'm going to put my first CP just below this low. Okay, second CP is going to be this higher time frame support. Then from there, I'm going to look to buy Euro pound all the way up. So tomorrow's trade, the only value trade I'm looking at for tomorrow is short on Euro pound. We're going to use surplus just has to be above old eyes. That is going to be about 24 pips. Okay, 24 pips, and then your TP1 is going to be TP1 0.84447. Then TP2 is going to be 0.98399. So I think this is valid for tomorrow. What I'm going to do is I'm going to send it out to the Telegram right now. Let's see. So sell on Euro pound. Let's see. Screenshot this. So I sent out my charts to the group. Euro pound. Come on. Euro. All right. So check the channel. Euro pound sell. Then. Right. So we are bearish on EU, GU, gold, NU, AU, GJ, and EG. GBP is actually for the first few days of the week. We're bearish on Euro pound. And we want to see what Euro pound is going to do going into Wednesday and then Thursday. All right. So this sums up my weekly outlook. This is what I'm looking at price during this week. So still looking at the bullish DXY. I'm not assuring that you're going to get bullish DXY, okay? But I'm saying this is where I want to see in the market. So the bullish DXY, if the DXY actually goes bearish, then I'm going to go back to my charts and then see what I missed, okay, and send out an updated chart or when we're doing one of our sessions on the 3-week bootcamp, I want to give you guys more outlook. But I feel, or I know the extra is going to go up due to all these different factors we are bringing in together. So this brings us to the end of my weekly outlook. So what I'm going to do now is I'm going to close out this link, okay? Then I will send another link to the 3-week bootcamp group, and then we're going to go as scheduled on today's series, institutional manipulation and stop runs. Okay, so thank you everyone for being a part of this group. The webinar is recorded, and I'm going to send it out to the channel. So send out this recorded version to the channel, and then bootcamp guys, this is your cue because we're going to have a session right now. Okay.